In exactly 2 hours, 8:30 a.m. Eastern, the most important number of June drops. U.S. CPI for May 2026. The market expects 4.2%. If that number hits, Goldman Sachs just scrapped all rate cut forecasts for 2026. BNP Paribas is now calling for rate hikes starting December. Gold is already below $4,300. A 4.2% CPI print could send it to $4,000. But if inflation surprises lower, everything reverses. Today, before the number drops, I am going to tell you exactly what to watch for and exactly what to do in either scenario. Welcome to Financial News Daily. Welcome to Financial News Daily. Today, Wednesday, June 10th, 2026. This is CPI Day, the single most important data point of the month. 3 things today. 1, what the data is expected to show. 2, exact market reaction for each scenario. 3, what to do with your money before and after 8:30 a.m. Let's go. Here is where we stand going into today's CPI release. Last week's context. April CPI, 3.8%. May jobs report, 172,000, double forecasts. Fed rate hike probability, 40% for December. Goldman Sachs update, June 9th. No longer expects Fed to cut rates in 2026. Rate cut forecast pushed to June 2027. Probability of a rate hike raised from 10 to 20%. BNP Paribas now expects Fed to start raising rates in December and continue hikes into 2027. This is the most hawkish shift from major banks since 2022. Today's expectation. Market consensus. CPI at 4.2% year-on-year. Core CPI up 0.5% month-on-month. Why 4.2%? Energy prices drove the spike. Oil above $90 for most of May. Iran war keeping supply disruption fears alive. Producer price index already jumped to 9.8% in April, signaling more consumer price pressure ahead. If 4.2% is confirmed today, this is the highest U.S. inflation reading since mid-2023, and it gives the Fed almost no choice but to act. The Iran nuclear deal progress announced yesterday briefly pushed oil down 4%, but one data point does not fix 3 months of energy-driven inflation. Today's number was baked in before yesterday's ceasefire news. 3 outcomes. Exact reactions. Scenario 1. CPI at 4.2% or above. This is the consensus expectation, the worst case for rate-sensitive assets. Gold drops immediately to $4,100 to $4,200. Rate hike probability jumps to 60%. Real yields spike, gold's biggest enemy. Stocks. S&P 500 down 2 to 3% on open. Growth and tech hit hardest. Defense and energy hold or gain. Dollar strengthens sharply. Stronger dollar amplifies gold's decline. Fed. June 16-17 FOMC becomes the most watched meeting of 2026. Warish statement will be parsed word by word for hike signals. Bonds. Short-term yields spike further. 2-year Treasury approaches 4.5%. Long bonds sell off again. This scenario confirms the war inflation is not temporary. The Fed must respond. Goldman and JP Morgan year-end gold targets become very difficult. Scenario 2. CPI at 3.5 to 3.9%. In line with recent trend. No surprise. Markets stabilize. Gold holds 4,300 to 4,450. No directional conviction. Focus shifts immediately to June 16-17 FOMC. Stocks. Flat to slightly positive. Relief rally, but limited upside until Fed gives clear signal. Fed. Extended pause most likely. No hike, no cut, watch and wait. Most likely scenario based on current positioning data.
Scenario 3. CPI below 3.5%. The surprise that changes everything. Gold snaps back to $4,600 to $4,700. Rate hike fears evaporate. Dollar weakens immediately. Safe haven bid returns. Stocks. Strong rally. 1.5 to 2%. Rate-sensitive sectors lead. Real estate, consumer, utilities. Fed. December cut back on the table. Goldman's $5,400 gold target lives again. JP Morgan's 6,000 becomes credible. Probability assessment. Above 4.2%, 45%. Between 3.5 and 3.9%, 40%. Below 3.5%, 15%. The base case is a hot print, but the market is positioned for it. A miss in either direction creates the bigger move.
Yesterday, Goldman Sachs made the most significant forecast revision of 2026. They scrapped all rate cut expectations. Goldman's new timeline? No cuts in 2026. First cut? June 2027. Second cut? December 2027. They also raised the probability of a rate hike from 10 to 20%. BNP Paribas went further. Rate hikes starting December 2026, continued hikes into 2027. This matters enormously for gold investors. Goldman's $5,400 year-end gold target was built on the assumption of rate cuts in late 2026. With cuts now pushed to mid-2027, that target becomes very difficult unless geopolitical risk compensates for the rate headwind. The only scenario where Goldman's target survives: Iran war escalates again. Oil spikes above $100. Stagflation confirmed. Gold's safe haven premium overrides the rate pressure. That scenario is possible, but it requires the ceasefire announced yesterday to collapse, which, as we discussed yesterday, has a 55% probability. The market is now caught between two powerful opposing forces. Force 1, Iran deal progress, pushes gold down. Force 2, rate hike expectations, also pushes gold down. Both forces pointing the same direction is why gold has lost 22% from its January high. The only force that could reverse this, a CPI surprise to the downside today, or a ceasefire collapse this week. Here is the exact playbook for the next 4 hours. Before 8:30 a.m. ET, right now. Do not buy gold chasing yesterday's ceasefire bounce. The CPI number in 2 hours could wipe out any ceasefire gains instantly. Do not sell gold in panic either. Central banks bought 17 tons in April. China extended its buying streak to 18 months. The structural floor is real. Hold current positions. Let the data speak first. At 8:30 a.m., watch these in order. First, gold's reaction in the first 5 minutes. Gold moves faster and more honestly than any other asset. It tells you what the smart money thinks before analysts finish their reports. Second, dollar index direction. Dollar up, gold down. Dollar down, gold up. This relationship is mechanical right now. Third, 2-year Treasury yield. If it spikes above 4.2%, rate hike is being priced in aggressively. Gold will follow lower. After the number. Hot CPI, 4.2% or above. Do not panic sell gold immediately. Wait 30 minutes for the initial spike to settle. The real entry or exit signal comes 30 to 60 minutes after release, not in the first 5 minutes of chaos. Cool CPI, below 3.5%. Deploy cash reserves into gold on the first pullback after the initial spike. Do not chase the immediate move higher. Wait for the first 1 to 2% retracement. Inline CPI. Hold everything. Focus shifts to June 16-17 FOMC. That becomes the next trigger. CPI day summary before the number drops. Expectation, 4.2%. Goldman, scrapped rate cuts. Hike probability, 20%. BNP Paribas, hikes starting December. Gold, below $43, under pressure from 2 directions. Iran, ceasefire fragile. Lebanon, wildcard active. The 3 numbers to watch at 8:30 a.m. Gold reaction, first 5 minutes. Dollar index, direction. 2-year Treasury yield, above or below 4.2%. And the key rule, do not act in the first 5 minutes. Wait 30 to 60 minutes for clarity, then act with conviction. The investors who make money on data days are not the fastest. They are the most disciplined. Everything here is for informational purposes only, not financial advice, not a recommendation to buy or sell. All data as of June 10th, 2026. Please consult a qualified financial advisor before investing. Give us a like if today's pre-CPI briefing helped you prepare. Hit follow for the post-CPI reaction video, dropping later today. Stay informed, stay ahead. Financial News Daily.